HDFC second quarter earnings are out. We've got the net profit coming in at about 1270 crore rupees. That's the first figure that's come out. The estimate really was about 1255 crore rupees, so it's slightly higher than that versus what we saw last time around, which was about 1151 crore rupees. The total income has come in at about 5950 crore rupees. That's the total income as far as HDFC is concerned. Their loan book as of September 38 stands at about we'll just get this figure sorted out, but their loan book figures are also out. That's the total income figure at 5950. Net profit is marginally more than what our poll was suggesting, which was at about 1255 crore rupees. It's come in at 1270 crore rupees. What will be interesting, of course, is to watch out for what really happens on the loan book front, and if there is any slippage at all when it comes to their NPAs, because usually you've seen that HDFC is held on and not really seen any concerns regarding their asset quality. So that is something that we will have to watch out for. Awaiting more details as far as their provisions is also concerned. Just to take you through what we were expecting on the provision front, we were expecting that their NPAs will be flat. As far as provisions are concerned, that will also remain flat, so watch out for any movement on that front. The loan growth is actually expected to go up by about 19 to 20%, and so we'll just see what happens to that. But on the profits basis, it's pretty much in line, but as we can see, the stock is still down by 1% after those earnings data has come out. Let's try and see if we can get more perspective going. And I think we have Nitin Kumar, he's a banking analyst from Quant Broking, who's joining us on the phone line. Nitin, first look at the numbers. How is it looking for HDFC?
Yeah, the numbers seems to be on track. The PAT at 1,265 crores is in line with the estimates of 1,259 that we had. And II at 1,600 plus 1,605 crores is slightly ahead, 1.5% ahead of our estimates. And accordingly, I expect the spreads to have remained stable. Though even the loan growth at around 19% growth looks to be on track. This quarter, the management mentioned that they have not sold any loans to HDFC Bank, and which has helped this kind of loan growth. So sequentially, we are seeing 4% loan growth for HDFC, and the PAT moderation at around 10% growth is due to the lower cap gains and the dividend income this quarter.
Anything which is outside of what was expected, any aberration from what the street was expecting that needs to be highlighted at this point of time?
Doesn't seem so. Maybe the outlook on the gains and the dividend income, cap gains and the dividend income, because this quarter, like the PAT growth has slowed because of that only.
Okay.
So more clear on that, and secondly, the profitability in the individual business, because incrementally the higher spreads are coming in from the corporate and the developer portfolio. So the outlook on the spreads, even though in the near term, or at least for this quarter, they have been able to be in the guided range.
I know this is not really on top of the list when it comes to HDFC, but the provisions have come in at about 15 crores, which is almost half of what we saw last time around. Is that something that the street really watches out for when it comes to HDFC?
Not much. Like I think at 15 crores they are lower than the estimate, so it has again given another 10-15 crore boost, 10 crore boost to the PAT, and so we were expecting provisions of 30 crores. Last quarter also they had 30 crores. So at 15 crores it is on the lower side, and given the environment, one would typically believe that the provisions could increase because of the rising delinquencies, but HDFC typically have a very strong credit policies and risk control. So because of which I think the provisions have held up at a very low number.
Nitin, just very quickly, the stock seems to be recovering. What would be your final call as far as the first look at the earnings are concerned? That are you happy with these numbers?
Yeah, overall we are happy. Like the numbers seem to be on track. We would look for the management commentary on the growth and the spreads movement going ahead. And now that with the wholesale costs coming off in the system, and which will help lower the borrowing cost for the company, I think one should continue to hold these stock. We have a positive rating.
All right, Nitin, thanks for joining us. We'll come back to you once a deeper analysis has been done and the management has spoken to us, so we have more understanding of what they are thinking as far as HDFC's outlook is concerned and the second quarter earnings. Just to recap, while we see KK Mystery, they're getting ready to speak to us. Your NII is coming at about 605 crore rupees, so that's a growth of almost 16%, exactly what we were expecting. On the profits front, it's slightly better at a growth of about 10%. At about 1270 crore rupees. Your loan book actually has come in at about 1.85 lakh crore. That's the loan book for them. Nothing much different as far as their loan book growth or the asset quality is concerned. So on both those fronts, it seems to be okay, but we'll really wait and watch of what the management has to give in terms of indication. The stock has marginally recovered from where it was. In fact, significantly, it was down by almost 2% at one point of time, and now is down by about 0.7% at around 814. Those are the HDFC numbers. The income has come in at about 5,950 crore rupees. Their EPS actually is at about 8 rupees versus 7.53 rupees that we saw last time around. And in fact, now let's just try and listen into what KK Mystery really has to say.
The accounts for the 6 months ended September 2013, and I thought we'd run through quickly some of the key financial numbers and then take any questions that you may have. When you look at the loan book, there has been a lot of worry in the market and particularly in the media about a slowdown in the economy and slowdown in growth and demand for housing not taking place and so on and so forth. So we are glad to report that our total loan book outstanding on 30th of September amounted to 1,84,886 crores of rupees, which represents an increase of 19% over the previous year. However, this number of 19% has been calculated after taking into account the loans that have been sold in the last 12 months. So if you see in the last 12 months, we have sold loans aggregating to as much as 3,792 crores. If we add back these loans sold, then the growth in the loan book would be as high as 22%. Now, even though 22% is the total loan book growth, if you break down the loan book growth between the growth on retail loans, which is our core business, individual loans, and non-individual loans, you will see that the growth is largely coming on individual loans. So if you take the first 6-month period, then the growth in the loan book for individuals after selling loans was 26%. But if we add back the loans sold in the last 12 months, then the growth in the individual loan book is as high as 29%. As of 30th of September, we are today carrying a total of 16,497 crores of rupees, which is in respect of loans which we have sold, but on which we get a weighted average return of 1.29%. Now, the way this works is that we sell a lot of our loans every year, and when we sell a loan, we don't book accounting profits upfront. So, for example, if the underlying interest rate on a loan that we have sold, for argument's sake, is let's say 10.5%, and we have sold the loan, let's say at, again for argument's sake, 9.25%. The customer continues to pay 10.25% to us. Of that 10.25%, we retain in this example 1.25% as our income and pay the balance back to whoever we have sold the loans to. So that then creates a stream of income for future years. So on 30th of September, as I said earlier, we have 16,497 crore rupees of loans, individual loans, sold by us, but on which we are getting a weighted average return of 1.29%. As I said earlier, the growth in the loan book is largely on individual loans. So if you look at the incremental growth and break that down between individuals and non-individuals, 91% of the growth in the loan book is on individual loans and only 9% is on non-individual loans. Our spread as of September stood at 2.24%. If we break down that 2.24% between individual loans and non-individual loans, individual loans carried a spread of 1.98%, non-individual loans carried a spread of 2.76%. If you look at net interest margin for the first quarter of the year stood at 3.9%, but historically if you see for the last many years, you will see that with every quarter, the net interest margin tends to get higher and higher. And if you were to look at the 6-month period, the net interest margin numbers stood at 4.1% as compared to 3.9% in the first quarter of the year. Non-performing loans as of 30th of September stood at an aggregate of 0.79%, and this compares to 0.77% in June. So there is a marginal 2 basis points increase in the non-performing loan number. However, if you look at the breakdown of the non-performing loans between individual loans and non-individual loans, then individual loans has shown a further improvement from June. In June, the non-performing loan number was 0.61% for individuals. It has now come down in September to 0.59%. But there is one particular loan which was given, which we have classified as a non-performing loan in June, and there is a second loan given to that same company. This is HIRCO, which is also being classified as a non-performing loan in the September quarter, and therefore we have reversed the income in respect of that entire loan. Now this is a technical default. The land is good, the property is very good, the security is very strong, but there is a dispute between the two partners who are doing this project. So we will acquire this project through a SARFAESI route and we will auction it. The auction would probably be taken up by one of the two parties who are building this, who are doing this project. So the non-individual non-performing loan number now stands at 1.19%. The overall non-performing loan number, I repeat again, stands at 0.79%. If we look at the regulatory provisioning under the NHB rules, there has been some reduction in the level of provisioning that is required. It was first introduced by RBI and was applicable to banks. It is now applicable even to housing finance companies. So as a result of that, the excess provisioning that we are carrying today on 30th of September stands enhanced to as much as 493 crores. So we carry a provision which is 493 crores higher than what we are required to carry as per regulation. The actual provisioning we carry is 1,811 crores against a regulatory requirement of 1,318 crores. Because of the provisioning change where there is a reduction in the level of provisioning that we need to make for loans given to property developers for residential housing, there is a saving of the provisioning amount to the tune of about 45 to 50 crores. So we are taking that benefit of 45 to 50 crores on a pro rata basis over the next 3 quarters. So to that extent, the provisioning figure for this quarter is lower, but you need to bear in mind that we still carry after that an excess provisioning of 493 crores beyond what is required by regulation. As you are aware, we hold all our investments under Indian GAAP at historical cost and not at fair value. If we were to fair value the listed investments, let's talk only of listed investments where there is a transparent stock market valuation you could look at. The unrealized gain on those listed investments as of 30th September stood at as much as 28,938 crores of rupees. So we carry a huge amount of unrealized gain on our listed investments, which is even higher than what our shareholders' funds today are. Our book value per share number stands at 178 rupees, but if we take into account the 28,938 crores of unrealized gain, add that to shareholders' funds and then compute the book value per share number, the number would increase from 178 rupees a share to 364 rupees a share. And mind you, 364 rupees a share would not value or would not give any value to our investments in our unlisted subsidiaries. So if we were to look at life insurance, general insurance, asset management, venture capital, there would be a huge amount of unrealized gain on those investments also. I'm not giving you any number because there is no transparent stock market valuation on the unlisted investments. Now there has been a reduction when NHB made the change on the provisioning requirement where they reduced the level of provisioning that was required. They also reduced the risk weight in respect of certain categories of loans. So because of the reduction in the risk weight, our capital adequacy would have stood enhanced to a level of as much as 19%. If we break down that 19% between Tier 1 and Tier 2, then Tier 1 capital stands at 16.5%, Tier 2 capital stands at 2.5%. But what we are also declaring from this quarter onwards is what would be the impact on capital adequacy if we were to reduce the investment in our bank from Tier 1 capital. So theoretically, if we were to reduce our investment in the bank from Tier 1 capital, then the capital adequacy number would remain at 16.1%, which is broadly in line with what the number was in the June quarter, even after reducing the investment in the bank from Tier 1 capital. Now, just to put that in perspective, all our investments in subsidiaries, which is life insurance, general insurance, asset management, venture capital, and so on and so forth, we reduce those investments from our shareholders' funds for calculating our capital adequacy. But in respect of the bank, because it is not a subsidiary, it's an associate company, we have always been treating it as a risk-weighted asset. But a lot of analysts have been asking us what would be the impact if we were to reduce the investment in the bank also from Tier 1 capital. So with the reduction in the risk weight, I'm glad to say that the capital adequacy number continues to remain a very healthy 16.1%, even if we reduce the investment in the bank from Tier 1 capital. Now, if you look at the profit for the quarter and for the 6-month period, the profit before the pure operating profit, which is profit without taking into account profit on sale of investments, without taking into account dividend, and without taking into account tax. That number grew by 16% both for the quarter and the 6-month period. So 6-monthly quarterly profit before dividend, before profit on sale of investments, before provision for tax for the quarter was 1,464 crores compared to 1,260 crores last year at this time, giving an increase of 16%. The 6 months profit calculated on a similar manner stood at 2,855 crores compared to 2,460 crores last year, giving a similar increase of 16%. But as I said in the beginning, dividend income for this year or this quarter is lower than what it was last year. The reason being that HDFC Bank had declared dividend in the first quarter of the financial year this year, whereas last year the dividend was received in the second quarter of the financial year. So because dividend income is lower and because profit on sale of investments figure is lower, the post-tax profit, if we were to look at, stands for the quarter at 1,266 crores rupees, which compares to 1,151 crores in the previous year, giving an increase of 10%. The 6-monthly profit figure stands at 2,439 crores. This is post-tax, post-profit on sale of investments, post-dividend, compared to 2,153 crores last year, giving an increase of 13%. Now, we have a number of subsidiaries, the life insurance, the general insurance, the asset management, the venture capital companies, all of which are now maturing and generating higher and higher profits every year and every quarter. So if we were to look at our consolidated profits, and when I talk of consolidated profits, I'm even reducing the charge to our share premium account in respect of zero coupon bonds. Even after reducing that, the consolidated profit after tax for the second quarter stood at 1,806 crores rupees compared to 1,455 crores last year, giving an increase of 24%. If you look at the 6-month period, the 6-month consolidated profit stands at 3,426 crores rupees compared to 2,582 crores last year at this time, giving an increase of 32%. And as we've been saying time and again, the share of profits of the subsidiaries as a proportion of the consolidated profits of HDFC keeps rising every year. And in the first 6 months of this year, the subsidiaries now account for as much as 32% of our consolidated profits, compared to only 24% in the previous year. So these were the broad financial numbers and the broad operating numbers. Be happy to take any question.
How much is the NII growth, sir?
Net interest income, it depends on how you look at net interest income, because some analysts look at net interest income including dividend, some look at it excluding dividend. So if you were to look at the net interest income including dividend, which is where a majority of people look at, that number stands at 1,814 crores, which is an increase of 11% over last year. But that is because of the fact that dividend income in this quarter is lower than what it was in the previous year. Because, as I said earlier, HDFC Bank paid dividend in the first quarter this year compared to the second quarter in the previous year.
1814.
1814.
So just a clarification on that Hilco part, which was classified as an NPA in second quarter.
No, the bulk of the loan was classified as an NPL in the first quarter, but there was a second loan which was given, which was not an NPL in the first quarter because at that time payments were coming in, which has now been classified as an NPL in the second quarter. There is an NHB circular now, which also says that if one loan given to a company is NPL, then any other loan given to that same company will be treated as NPL.
So how much is the loan outstanding to that particular account? Sorry.
It's about 460 odd crores. So it's a bulk of the non-performing loan number. Bulk is that one loan. Also, there is an income reversal in respect of that loan. So there's nearly 50 crores of income, roughly, which has been reversed because once it's an NPL, we don't account for income on an accrual basis.
Is it the sole reason that you're kind of looking trend of having lower gross NPL?
That is the only reason. If you remove that one loan, then the NPL number would be a lot lower than what it was in the June quarter or the previous year, significantly lower, 0.59%. And the jump you see in non-individuals is only on that one account.
And sir, how have your cost of funds performed lately?
See, at the end of the day, we look at spreads. So cost of funds keep changing day in and day out depending on where rates are, where bond markets are trading, where, deposit rates have not really changed much. So in the last last month or so, post a reduction in the MSF rates, there has been clearly a reduction in the cost of funds. But before that, there was a sharp rise in the cost of funds. So what we did is we raised a lot of money in the second quarter of the year, largely from banks. But these loans generally carry a clause which gives us the ability to go and prepay these loans when we want, with an appropriate notice. Yeah, of course. There is a SARFAESI procedure which has started. The SARFAESI may take a quarter or two for it to culminate. Once that SARFAESI procedure is over, that land would belong to us. We will auction that land and get our money. The land value, I can tell you, is probably 2,000 crores or so. Whereas the security, the loan outstanding is about 460 odd crores. So there's a huge cover. There's a massive cover. But temporarily, till such time as we get the land and auction the land, we'll have to classify the loan as a non-performing loan and we'll stop accruing income on the loan.
Are you the only lender on that project?
To the best of my knowledge, we have a separate section which we have lent to. There may be others who may have lent for some other land.
And sir, as far as the individual and non-individual loan book is concerned, you said that nearly 91%
of the incremental growth was an individual.
Looking at increasing somewhat even on the non-individual side?
We do look at it. There have been some loans that we have looked at. Disbursements would probably happen over a period of time. But generally we've seen over the last 18 months that the growth that we have been seeing is largely coming on individual loans.
And so your outlook on margins as well as spread?
See, we've always guided you towards spreads which would be in the range of 2.2 to 2.3 and we continue to believe that spreads would remain in that range of 2.2 to 2.3.
And margins?
Margins get impacted by a whole host of issues which have nothing to do with the operating business, in the sense that if you raise capital in a quarter, spreads, your margins go up and so on and so forth. So I would expect margins with every quarter to remain stable or get a little higher, marginally higher. So our margins, which were 3.9% in the first quarter, improved to 4.2% in the 6-month period. So there's an expansion in margins. I would say upwards of 4 is what our expectation would be.
Do you continue to expect individual loans to outperform?
I would hope so. We see nothing today which would give us or which would make us worried on that front at all.
Will you be still on track for the targeted growth for this year?
We've always talked of a growth of 18 to 20% and we are on target for that 18 to 20% growth.
Any offers that you're looking for festive season?
I'm sorry?
Any festive season offers?
See, these are offers which we would debate on a continuous basis and come out with something whenever we... Sorry, you had a question.
Okay. Sir, I just wanted a clarification. This time around, HDFC Bank said that they didn't really buy loans from...
That's correct. They did not buy loans.
Then clarify as to why and...
Well, that's a question you have to ask the bank, because the option is with the bank whether they want to buy or not. This quarter they did not buy, but there have been many quarters in the past when they have not bought loans in one particular quarter, and in the next quarter they've gone and bought loans not just for that quarter but even the earlier quarter. So I don't know what the bank would do. It's really the bank's call.
But that has not really impacted the...
And that doesn't have any impact for us. No. When we talk of our growth, we add back loans sold, which is where you get the 29% individual growth.
So अगर हम देखें HDFC लाइफ इंश्योरेंस और जनरल इंश्योरेंस, वहाँ पर ग्रोथ कम हो रही है क्योंकि आपकी कंपनी दोनों प्रॉफिट में जाती है, मतलब HDFC लाइफ को प्रॉफिट नहीं, म्यूचुअल फंड में भी दिक्कतें आ रही हैं, प्लस हाउसिंग की डिमांड जिस हिसाब से होनी चाहिए इकोनॉमिक स्लोडाउन को देखते हुए नहीं होगी, तो आगे अब क्या सोचते हैं कि इसकी वजह से कुछ इम्पैक्ट पड़ेगा?
See, if you say that housing is not growing, then it is difficult to explain a 29% growth. That is the first point. Second point is if you say that all the businesses are slowing down and subsidiaries are slowing down, then I mentioned that the share of profits of the subsidiaries is now gone to as much as 32% of the consolidated profits compared to 24% last year. So these businesses are doing well. Yes, life insurance is showing a slightly lower growth than before, but then from a profitability perspective, they are doing extremely well.
आने वाले समय
Okay, that was KK Mystery talking about HDFC second quarterly earnings, and there is really nothing there to disappoint. A good set of numbers, pretty much as expected, a little better than what was the street was really expecting, which is why you've seen that the stock has actually recovered a little bit from its day's low. It's down now by 0.6%, but at one point of time it was down by 2%. Quickly recap it. NIIs are up by 11% for HDFC at about 1,814 crore rupees. The profits are up by about 11%. We were expecting at about 9% growth, so that's much better than what the estimate was. On the gross NPA front, it now stands for second quarter at 0.79% versus the last time around when they saw 0.77% of as a percentage of gross NPA. So that's the slight slip that's really taken place. But your provisions are down by 50%, and the key takeaway there was KK Mystery really saying that they've seen a strong loan book growth, especially from individuals, which is your retail segment for loans, has actually shown some good demand. We'll probably see some kind of reflection that in the real estate market also, but largely your individual loans have grown or contributed to the growth by almost 90%. Stocks down still 0.5%. Those are HDFC earnings along with what the management really had to say about their performance. That's all the time we have in this edition of Market Pulse. Coming up next.